All right.
There's Jawwad Khan. Should I admit him?
हाँ आने दो बेचारे को बेचारा he's a class rep.
I think I should. I'll just let people in, Jawad.
नहीं नहीं I have a reputation to protect.
I know, but you're not the host anymore. But I, I was slightly more generous with this stuff. But
I
there's no way to get them to push up. So I think we'll be fine.
knew I was going to regret it. All right, okay, chaleं. So Mubariz, let's start. I had a list of questions, and I think the bachas also have a list of questions. I think my first question to you. Acha, by the way, this is being recorded, so everybody, this is not just being recorded. It'll also make it to YouTube as early and quickly as possible. So be very careful with what you say and the comments you make. Everything is going to go up in public domain. Mubariz, pehla sawal. I think the first question is that there is this view or this perception that there are two sides to a negotiation table, especially when it comes to venture investing. And I think my question to you is how do you balance that? How are you supposed to balance that? Especially
So yeah, go ahead. Sorry.
so especially um, as a both from the point of view of a founder as well as from the point of view of an investor. You know, when you represent as a lawyer, when you represent a founder, what are you looking at? And as an investor, when looking at a founder, what are you looking at, right? So I'll start with that. That's my first question. Over to you.
Okay. No, thanks for that. It's really different, right? Because one is the buy side, one is the sell side. The buy side is the investor who's looking to buy into equity. The sell side is the founder who's looking to sell equity, right? It really your leverage really depends on where you on the context around the business, around the investor, around who else is willing to invest. So when if you're a founder who has a substantial amount of interest from different VCs, you have great leverage over any negotiation. I've seen founders who just put the terms down and that's it. But there is typically a lead in this who has afforded the founder that kind of leverage. Um, as an investor, the interests that you're looking to protect are around twofold. And I think this question will also come up later, but I'll lay the groundwork right now. Is around when in any deal, in any venture deal, investment deal, there are broadly the terms are divided into two big sections. One is terms that pertain to finance, like return, and one like economics, and one set of terms that pertain to control. So if say it's about valuation, that falls within economics. It's if it's about board members, if it's about reserve matters, it's in the control category. Generally, the investors are looking to make sure that number one, they have a deal in which they can get a substantial return, and that is the valuation conversation, liquidation preference conversation, etc. But more so on the control front. Say if things are going south, how does the investor make sure that their investment is protected, and how do they ensure that they can get the best value out of it, or at least salvage whatever investment that they've made, or at least make as much money out of it that they've put in. Does, does that
Yeah, it does. Thank you so much for that. I think a follow-on question on this is, you know, when you look at, so you mentioned two things. You said return and control. With respect to return, you know, are there any guidelines? Are there any benchmark? Is it like a free for all? You know, if you can get away with murder, will you try and go for that, or would you sort of control yourself? And I'm not just speaking. Speaking from both perspective. You know, what's the incentive for both sides to play fair?
No, that's a good question. And what constitutes as murder is varies from ecosystem to ecosystem, right? I would say if a company is raising in Pakistan at say even if it's at a $3 million post money valuation, that's not really murder. And that's not really something too bad. It's still okay. It's actually a decent deal. This is what the market is. But if in the Valley YC graduate companies raising at 3 million post, that could constitute as a murder, right? Given those circumstances. Now, Pakistan has seen, at least we have seen over the post 4 or 5 years, and Jawad, you were part of this ecosystem where people really got away with taking substantial stakes, right, in a company. Now, to understand how the dynamics work, it's very important to understand how venture capital works. Venture capital is flowing from investors, LPs, limited partners, who are investing in funds to make sure they get outsized returns in businesses. The thesis is that if the investor takes a very small chunk of the business and leaves a big chunk with the founder, then as and when the founder keeps raising more and more capital and keeps getting diluted, at least the founder will be incentivized to run this business for the next 7 to 8 or 10 years. And in the next 7 to 10 years is when the investor is looking to make an outsized return, which is 10x or more, maybe 100x or 200x. And if you look at the history of VC funds and VC fund returns, it's typically one deal that returns that makes all the returns, and maybe even two if funds lucky. But yeah, so everyone's looking to secure their position in that deal that way. And the idea is that if you do not play ball early on, the company would not be in a position to raise more capital later on. So if the investor comes in early and takes a big chunk of equity early on, it's 40%, 50% type, the founders will not be able to raise substantial amount of money. And now this only applies if you're talking about a business with a venture profile, which is capable of making outsized returns very fast in the next 7 to 10 years type.
Sorry, Mubariz. I have to remind myself that I'm on mute and I have to unmute myself. All right. So that's two questions. There are two terms that you used in your description. You said pre and post. Could you sort of explain that a bit to the crowd, to the group?
Sure. Whenever you talk about valuation in any deal, I think the most important thing to do is to clarify what you're talking about, because it could mean two very different things. It could either be a pre-money valuation or it could be a post-money valuation. The difference is very simple. If you're going to raise money or going to raise investment, pre-money valuation is the value of the business before the investment is injected. Post-money valuation is the valuation of the business after the money is injected. So if, for example, if a business is raising $1 million for 10%, then before the $1 million were injected, the value of the business was $9 million. And after the $1 million were injected, the value of the business is $10 million. So that's the pre and post money valuation difference.
And does that sort of make a huge impact or dent in the valuation discussion? Why is there so much sensitivity around that?
Because the problem is, if I tell you I'm giving you, for example, $1 million at a 9 million valuation, if it is a pre-money valuation, then I'm talking about 10%, because post-money is $1 million, is 10 million, and I get 10%. But if 9 million is post, then I'm getting more than 10%. I'm getting around 12 type percent. And so there's a whole difference of 2 odd percent. Therefore, pre and post money could really be, you could be literally having a whole conversation or even getting into the deal, and you could really be talking about two different things. So which could obviously result in in not a meeting of the minds, which is required for a contract.
Okay, fair enough. Thank you for that. So we've spoken about three things. We've spoken about the fact that there are two sides when it comes to a term sheet. There is a founder side and there is an investor side. We've spoken about the fact that there is a natural balance that seasoned investors and founders understand. So they don't try to take advantage of each other, because that's just short-term thinking that sort of bounces back or bites back in the end. And we've spoken about pre and post money valuation, right? We've spoken about these three aspects. I think my next question is that from a founder's point of view, first, specifically from a founder's point of view, what are some of the key terms that you should be aware of, that you should understand? And then once we've done the founder side, from the investor side, from the investor point of view, what are some of the key terms that, you watch out for?
Okay. So as I said, when you divide the terms into economics and control, it's very important for the founders to make sure that anything that does not fall within or any terms that do not affect the economics of the deal or the control uh, are kind of not relevant, right? So it's very important not to get too tied up or too bogged down with the mechanics in a contract, and it's very easy to fall for that. So just to give you an example. Um, when you talk about economics in a deal, the main terms are your valuation. They pertain to liquidation preference. Now, liquidation preference is, think of it, the simplest way to think of it is that it's the minimum return an investor is getting if the company's assets are worth anything. So, for example, if the investor invests at a $10 million valuation, say, before gets to 9 million pre, 10 million post, has 10% for $1 million, and has 1x liquidation preference. What that typically means is that if the business is being sold, say someone wants to acquire the business for $5 million, which is half of what the valuation the investor came in for, the investor would still have the right to take his entire $1 million upfront because that's 1x liquidation preference. Now, if the liquidation preference was 2x, the investor would be taking $2 million upfront, and only then the rest would be getting anything, even though his 10% would be worth $500,000 in that scenario. So liquidation preference is a very important term. It's very important for founders to understand that 1x liquidation preference is standard. It is what has happened across the world, what regularly happens across the world. But anything more is onerous. Other than that, there's anti-dilution protection, which is only applies in the case of a down round. Now, a down round is, say, you raise today at $10 million valuation post. Tomorrow, you're raising at a $7.5 million valuation. That's not a desirable outcome for any venture investor, because what the thesis is, or the theory, or what people want is that the value of the company will keep increasing, and hence the value of their share and their stake would keep increasing. So anti-dilution protection is important for investors, where they say if you do it at a $7.5 million valuation, then we will get some more shares just to make up for the difference. Obviously, there are way more intricacies in each of these, but that's probably not the level of detail that's required at this stage. But other than economics, it's what's important is for the founders to focus on the control provisions. The control provisions pertain to board seat. You can't give every investor a board seat, and that board seat has to also be limited to a certain percentage that the investor holds. Once the investor goes down a certain percent, they should pretty much be losing that right to appoint a director. Other than that, there's this thing called reserve matters. Now, reserve matters or protected provisions are basically a minority protection mechanism. So if I own, say, 10% or 20% of a business, I've put in all the capital, like people in any venture investor does, there's no way for me to make sure that I'll always get outvoted by the founders who own the remaining substantial amount of the business. What investors or what typically minority shareholders do in this situation is they say that XYZ items can only pass on the board level or on the shareholder level if the investor also approves. So the investor cannot take them through on their own, but investor can stop the founders from taking them through. So, for example, if the founder creates a certain class of shares which has lower voting rights or does not have the same preferences, etc., just to outmaneuver or take the investor out or dilute the value of investor shares, they should be able to do that. So there's these kind of protection mechanisms that fall in the control thing. Now, what is important for the founder to do when they talk about control is to make sure that whatever control provisions they allow are reasonable. That's something that the investor or any reasonable person would require to protect their investment. for example, if I'm putting, say, $200,000 in a company for 5% or even 10%, and the next, what's stopping the founder tomorrow from buying a company car for the CEO, right? A new Mercedes, and that's the kind of thing we want to be able to protect against. Otherwise, the investor is not someone who's being able to raise money ever to launch a fund. So it's stuff like that, but the founder should be very careful to make sure that none of these reserve matters would impede their operations of the business. And they only agree to reasonable stuff, reasonable protections that they would also want if they were investing. But no stuff that would lead to the founder having to call up the investor for permission every week type scenario.
Okay, got it. I think there were two terms I think where we may need a bit more hand holding. One is you said liquidity preference. So you said 1x is standard, 2x is onerous, right? So what does 1x and 2x mean? So for example, if an investor put in $1 million at, let's say, a $9 million pre-money valuation, and at the end of, let's say, 3, 4, 5, 6 years, the business is sold for $1 million total, right? How would, in that scenario, how would liquidation preference work?
Okay. So in a typical scenario, when a business gets sold, every shareholder gets proportionate to whatever they own, right? So in Jawwad's scenario that he just painted out, if I have 10% of a business for which I paid $1 million for the 10%, if the entire business gets sold for $1 million, then my 10% equals to $100,000, right? A liquidation preference is that I will get a minimum return of whatever I invested, right? That's 1x. 1x, i.e., whatever I put in, I'm taking the exact same thing out. So that's what 1x liquidation preference is. कि अगर मैंने $1 million डाले और कल को पूरा business $1 million का बिकता है, so I will get the whole $1 million, right? And nobody else has the right to get that money. But me or anybody else. Say if other investors also want liquidation preference, and they also get that kind of preference. But yeah, so essentially 1x means the amount that is put in. If you make it a multiple of 2x or 3x, then it means that मुझे $2 million मिलने चाहिए अगर मैंने 2x liquidation preference agree की होती. So if the entire business was being sold for, if I have 10% for 1 million is what I invested in, the entire business is being sold for example, 2.5 million. My 10% would be equal to 250,000. But if I have 1x liquidation preference, I would still take $1 million. If I have 2x liquidation preference, I would take $2 million out of the 2.5. That's how liquidation preference works.
So in Pakistan, in the local ecosystem, what's the benchmark? Is it 1x? Is it 1.5x, 1.25x, 2x? What does the number look like in Pakistan?
It's 1x, because for an investor to make sure that they can the company can attract further capital from global investors. And as you must be seeing that there's so much global interest in Pakistan. For them to be able to attract those investors, they have to play by the global standard, and the global standard is around is a 1x.
Okay, so that's one. Now, I think my second question, follow-on question, is that the way that you describe it sort of makes it sound as if we're not dealing with equity, but we're dealing with debt, because this sort of is very familiar to somebody who's borrowed money, and the take is that if things go south, then the debtors get paid, the lenders get paid first. Is that a fair assessment?
Well, yes and no, because typically what happens is if things get south, there's no one even paying the $1 million, right? It's zero, and in most cases it's zero. I would say WeWork is a good example for you to understand liquidation preference well, right? SoftBank invested what, $4.5 billion at a $40-odd billion valuation, but at the end the company was worth 8-9, but SoftBank was still on top as a priority list with the $4 billion to be converted. So it's really a downside protection, but in most cases, and especially early stage investments, the company does not have the assets to even return your 1x, and that makes it equity level risk. Because you're not taking any collateral, you're not taking anything else. It's just that If things are just really going south, then all I deserve is at least whatever I gave you, just give that back to me.
Okay, that makes sense. So I think I hope everybody understands what Mubariz just specified. That one would think that liquidation preference would sort of give venture investing or venture capital the profile of debt, but you're still taking risks because in the beginning, at the start, there's not enough of a balance sheet to even pay you back the 1x. All right, so that was one term. I think the second term that you mentioned that sort of caught my eye was anti-dilution, right? How does that work? As in, so if there is a down round, how do you, as an investor, how are you protected? Do you get more shares? Do you sort of put in less? How does the mechanics of that process work?
So in anti-dilution protection, there's multiple formulas and multiple ways of doing it, right? One is full ratchet, which is not the standard. Full ratchet basically means that, for example, मैंने invest किया 9 million post pay, prepay, and $1 million. Same example, and I get my 10% stake. अगला राउंड होता है 5 million के डाउन राउंड होता है 5 million post पे होता है. So they would say, okay, then in a full ratchet my 1 million should convert at the 5 million post, which basically means instead of 10% I will now be holding on to 20% of that business. That's not the standard. That's not what's typically done. The standard is broad based weighted average basis. What that typically means is कि अगर मैं 5 million post पे भी पैसे raise कर रहा हूँ, what will be taken into account is कि मैं 5 million post पे कितने raise कर रहा हूँ, and उससे overall dilution कितनी हो रही है, और वो थोड़े से extra shares issue होते हैं to make up for that dilution. There's a formula. I shared that term sheet thing. There's a whole formula to do the calculation and math around this.
Okay.
So that's pretty much the standard around how anti-dilution would work. You get more shares.
Perfect. Thank you so much for that. All right. I think the next question, and I'm still looking at term sheets. I think the next question from my point of view is that what's the legal standing of a term sheet in a market and an economy like Pakistan? As in, where's the protection? What framework or what rule of law ensures that the rights of investors and founders are protected?
Well, that's a good question, and I feel like that's
Touchy question, sensitive question.
I mean, it's the one where I would say is where Pakistan's the weakest, really. Even if you look at the ease of doing business ranking in terms of enforcement of contracts, Pakistan is, I would say, better than maybe 20 odd countries in the world only, and behind 130, 40 odd countries. It has to be enforced in court. There's no other way, right? Term sheets are typically non-binding. Term sheet is alignment on more basic or primary commercial terms, which you then give to your lawyers to go ahead and now start drafting the documentation around. The idea is that nobody wants to start incurring a substantial legal fee without first at least agreeing on broad basic principles or the commercial terms. Otherwise, enforcement is anyone's guess or anyone's luck, really. Pakistani courts typically work for people who want to stop things from happening, as opposed to making things to happen. So yeah, it's about whichever side you're on. Courts may or may not work for you.
Okay. But then, from what I've understood, what you've said is a term sheet is not the legal document. There is something else that happens after we've agreed on the term sheet, and would that be the share purchase agreement? Is that the right term?
So there's a shareholders agreement which governs the relationship of the shareholders, and there's a share subscription agreement in which the investor agrees to subscribe to shares. Now this is in a round which is priced round, which is what we call, where a valuation of the company is agreed and it's finalized. And okay, 9 million post hit, 9 million pre hit, 10 million post hit, 10% company ka hoga. So you know the number of shares and everything. Now there's another hybrid document or hybrid type of investment transaction called SAFE, and then which is a variant of a convertible note. A convertible note is debt which converts into equity upon a trigger event. SAFE is the same. The only difference between SAFE and a convertible note is that SAFE has no interest. Debt, a convertible note has interest. So what will happen is, I will give you $1 million today, saying that listen, we can't decide on a valuation because your business is too early right now. But this will convert at a future valuation when you raise at a price round. When a investor, institutional investor investing a substantial amount of capital comes in and determines the valuation of your business, तो मेरे भी $1 million उसी valuation पे convert हो जाएंगे. उस valuation पे एक discount होगा, उस पे convert हो जाएंगे. So there are two elements there. It's either a discount or a cap. So, for example, I give you $1 million today, saying these will convert at either a 20% discount of the next round or $5 million, which is the highest cap. Which again is kind of like agreeing on a valuation or the high ceiling of a valuation, but whichever is lower, and that's how a convertible note works, or say.
अच्छा आपने एक used one more term, which again caught my ears, is, and that is, you said cap. So there's this term called that we see floating around quite often, that's called cap table. How does that work, and what's the context around that?
Okay, so cap table is essentially the ownership record. It's a capitalization table of a company. It's basically essentially the ownership record of a company. So किसके कितने shares हैं, कौन कितना percentage own करता है, that's a cap table. So yeah, that's how that term is around. And when you talk about a cap table, what you're talking about is कि company में कौन कितने percentage share hold करता है.
So when people say, how is it going to impact the cap table, what does the cap table look like? All you're basically saying is, show me who owns what, and after this round is done, who will end up owning what. Is that a fair assessment?
Absolutely. That's what a cap table is.
Okay, perfect. Challenge. This is great. Achha, so again, if I come back, which was my query, my question was, how do you or who enforces and where does that come in? So you said that it gets enforced in a court of law, and the document that is then contested or that sort of becomes the basis of judgment is your shareholder agreement and the share subscription agreement. Is that correct?
Yeah, that's good.
And term sheet is the starting point for starting the discussion and the negotiation. And once you agree on the term sheet, then you move on to the next stage.
Yeah, once you've signed your shareholders agreement, what's idea is that your shareholders agreement and your share subscription agreement should reflect whatever you agreed in the term sheet. Once that's signed and once that's agreed, then the term sheet is done. It's also not a binding document, the term sheet. Typically, it's just a placeholder. इसमें एक term होती है binding, which is the exclusivity period, where the investor says, listen, to negotiate the definitive documents, the legally binding documents in good faith, for the next 3 months, you will not be negotiating with anybody else.
Okay, all right. And then in terms of diligence, how long does that take, or how does that process work? उसमें कितना time लगता है?
It depends on the stage of the company, and if it's an early stage company which is just raising money off the back of a pitch deck, you're really just diligencing the founders, you're diligencing the space they're working in, you're diligencing their ability to actually execute. But if it's say a bigger business which is raising a Series A, Series B, and substantial amounts of capital, or the business has been in operation for a while, then you're diligencing everything. You're diligencing कि अब तक जो काम हुआ है वो सही से हुआ है नहीं हुआ, अब तक जितने contracts हुए हैं, do the contracts have anything in it, whether the finances add up, whether there's an audit statement, whether the company represented position is actually true or not.
अच्छा एक चीज, I have sort of a follow-on question, and this is more from the downside point of view. So a group of founders go out and raise a round, and we've seen that happen quite a few times now, and the business sort of grows, does well for a while, and it sort of raises a fair bit of funding, and then it heads south, right? Or then the founders quit and they leave. So the investors are essentially the registered investors. They're on the board of directors. in instances like these, what happens to, let's say, tax liability? So for example, you're not compliant, आपने अपना withholding फाइल नहीं किया, आपने अपना पेपर वर्क फाइल नहीं किया, आपने SCCV के पेपर्स फाइल नहीं किए, for whatever reason, right? And 2-3 years down the road, you've quit and you've left as a founder, but the investor's name is there on the board of directors. So have you seen instances, have there been instances where this has sort of come back and to bite investors, or we're too young for that to happen as yet?
We're a bit young for that, but if a business has shut down and they owe FBR money, FBR could still go for the business. They could go for the directors. They could go for the people who are operating the business and actually were responsible for making sure that the tax is paid. But if those people are not around, and if the business does not have any assets, the claim is like kind of like falls short. Um, we do not have a very robust in tax enforcement mechanism either. We basically have more of a harass and grab type tax enforcement mechanism, but not in a situation where the business has fallen flat and does not have many assets anymore. The tax liability is not really this has not really come back to haunt any investor for sure.
So the legal liability component holds, right? That component has not been sort of broken or violated or probed by tax authorities in Pakistan, especially with respect to private limited companies and entities.
Yeah, I mean, in the sense that if you talk about limited liability, yeah, the liability is still of the company. But for tax, they have overreaching powers where they can hold the. I mean, at the end, they want a natural person who they want to hold accountable. If the legal person, the company cannot do it, then they go after the directors or the CEO. That's where they will go then.
Okay, got it. Okay, Ji. So then we have this, and then I think my next question was, if you think in terms of, so 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 any questions on term sheets from the room before we move on to the next topic? Sawalat? Are you guys clear on what Mubariz explained? Will you be able to answer questions and queries on this in the classroom? Have you understood it well enough?
I got a couple of questions in the chat. One or two was just like directed to me. There's if there is an anti-dilution clause and the valuation decrease, the investors would be getting more shares. I think we've addressed that. I think we question दोबारा यहाँ पे भी आ गया था इसमें. How do investors determine whether the founders are getting rid of the business or are they actually looking for investment to grow more? I don't understand this question well enough.
I think the intent is कि how do you know कि वो they're not going to run away with the money, or they just want to sort of. I think there've been a couple of instances where this has happened, where founders raised money, settled liabilities, and basically ran off.
Yeah, that's the diligence aspect, right? And that's why a lot of investors pretty much only deal with founders that have come through a warm introduction, or someone has not someone who's completely alien, or not someone you don't know from Adam. And so that's why I think investors are just careful around that aspect as well.
Okay, all right. अच्छा, so अब एक element तो हो गया, right? So boys and girls, any questions, बच्चास, on term sheets? Are you guys good? Quick show of hands, quick vote. So just respond with a yes or a no. Do you guys understood what Mubariz explained and you're comfortable with it? I only see Mubin raise his hands. Yes. So Khatija, yes, yes. Osama, yes. Saad, yes. Danish, are you good? Okay, I think we've got a good response to. Okay, fair enough.
Sir, I have a question.
जी पूछिए.
So if let's say the company is not doing well and उसकी liabilities जो है वो directors या फिर shareholders अपना director या CEO की तरफ आती हैं ना, like not the other shareholders मगर director या CEO को tax authorities for example पकड़ती हैं, तो would the director जो कि investor ने बिठाया हुआ है, would that person also be liable in that scenario?
No, that's a good question, and it's a natural question from what I know. What my answer to Jawwad's question was, yeah, nahin. Us waqt, obviously there is that liability, and that's why I mean, FBR तो अगर बुलाएगी तो फिर सबको सब directors को accountable hold करेगी, and that's why it's very common for investors in bigger companies or where substantial amount of money is being raised to get this director's liability insurance as well, which the company pays for. But essentially, what can be proved is that the management of the company was not in this particular director who is a nominee of another shareholder was in their hands. The operations were being run by somebody else, and the people running the operations are the ones who will be primarily held responsible.
Got it. Anybody else? किसी और के सवालात? Okay, fair enough. So now next question. So I think what is the next question is, these bachas finish this course, they graduate, they strike a oil well in their backyard, they end up with a couple of $1 billion in their bank account, and they want to start a venture fund in Pakistan. How does that work? How does the process work? How do you start one? What is required? What are the licensing requirements? What's the capital requirement? So let's start with
Well, yeah, okay, sure. Your primary regulator is the SECP. If you are the only person whose money is being invested, you don't really need to get the PEVC license, which is a venture capital license in Pakistan. The venture capital license primarily applies to people who want to manage other people's money. And to be honest, the regulated activity by SECP is you managing other people's money. And just to think about regulation generally, just remember it's typically about either when you're taking other people's money as deposit and managing it, either investing it or telling people where to invest their money, or those are the activities that the regulator really generally that fall within the purview of regulation. But if you are raising money from other people, and if you are investing that money into companies, then you need a license. That license does not have any minimum capital requirements as such, but what you need to do is you need to have the broad structure works in a way where you have the fund manager, the fund are the two separate entities. The fund manager decides where the investment will be made. The fund is where all the LPs, whoever's investing in the fund or whoever's money you're managing, they would put their money in the fund, and the fund manager then directs that money to the portfolio. It is the fund manager's job to then make sure that the portfolio is operating properly, that those reserve matters are there. Every time they give someone money, they have enough control provisions or protective provisions that would make sure that no one's going to just run away with the money. And then, of course, be able to get the kind of deals which would result in those returns that those LPs want. So broadly, that's the process and structure that you would need.
Okay. And how long does the licensing process work? So if you are going through the process, historically speaking, when people have applied for such a fund, how does that work? कितना time लगता है?
Well, SECP is now trying to encourage more Pakistani funds. Most of the funds operating in Pakistan are domiciled outside of Pakistan, and their LPs are also not in Pakistan. That's why they're just conducting investment activity in Pakistan, which is fine and allowed. The Pakistan PEVC license typically took very long, and that's why we have very few PEVC license holders in Pakistan. Pakistan's entire history, actually. But that process SCP has done quite a bit of work to streamline it. I think it would take you anywhere between 6 to 8 months to be able to set it all up.
Okay. And then I think the bigger question for me is, so you've sort of set up the fund, you've raised the money, you've invested it, you had a good eye, you had some really lucky bets, and some of your investments and checks have come back with really solid substantial returns. So how does the tax treatment work? So if you put in $1 million and you now sitting on over a period of, let's say, 7 or 8 years, you put in $1 million and you got, let's say, 20 million back, so you had a 20x return. How does the tax regime impact that gain?
Okay, so what the kind of money your tax, basically the tax that applies to you, or there are two ways a venture fund can make money, right? The main primary way is capital gains. You bought a share for 10 rupees a share in a private company. Now that share is worth 2,000 rupees a share, right? Or say 200 rupees, which is a 20x return. Uh, that's one way of making, that's the primary way most VCs make money. But there could be businesses that also issue dividends. And then you have a combination of the fund sitting on $20 million, which is a combination of capital gains and dividends. Each capital gains would attract a different tax rate, because it also is a function of how long you held those shares. For example, you invested in a company and 6 months later it got acquired. I mean, doesn't really happen very often, but if it did, then your tax rate is different on capital gains. But if you made a company and it gets acquired in 7 years, then your capital gains are different. Similarly, your dividend is also different. So you're paying tax on each transaction on which you make money outside your portfolio, and the tax treatment for each would be very different.
But if I just look at capital gains, and let's say we look at capital gains after a period of 5 years, so what's the rate for that? Is there like a benchmark figure, like 5%, 10%, 15%? Are you looking at 25?
From what I recall, it's 12 and a half, 10 to 12.5%. It starts with 17.5 or 20% and goes down based on the number of years you hold it. And I would not be able to tell you the exact figure, to be very honest. I forget. Because no one's really making money right now in this space, or make any capital gains in this space. So haven't had a look at the latest row, but it also changes every finance with finance with each finance bill. Also depends, like STZs, right? A special technology zone. If your company is vested in a special technology zone, your capital gains are exempt, and so are your dividends. So then you will just pay no tax on it.
So if the private equity venture capital fund is registered in the special technology zone, then everything is exempt. Or if
No, it's the underlying company, the share of which you're selling, that has to be in the special technology zone.
so the fund could be outside, but the investment is made in an STZ company, then everything is exempt. Gains as well as dividends.
Gains as well as dividends from that company are exempt, because your VC funds cannot be in an STZ as of now.
Yeah.
But they had their own exemption, but that's being revoked recently. I mean, the finance bill still hasn't passed yet. It passed today. I'm not. I have to check again whether those exemptions were actually removed or not, which was proposed earlier.
Okay. And then from the perspective and point of view of an offshore fund, right? So fund which is not domiciled in Pakistan, but is domiciled outside of Pakistan, and they invest in Pakistan. I'm assuming the tax regime is similar, or is the tax regime different?
It's similar. That they would be taxed on the Pakistan sourced income, and yeah, that's how they would have to pay tax. It'll also be a function of the avoidance of double taxation treaty between the offshore jurisdiction they're settled in, domiciled in, and the Pakistan company.
But tax is an important part of your design consideration, of your domicile consideration, and of your investment thesis, right? I just want to emphasize that that's true or that's not true. What's your take on that?
Well, it's an important consideration, because if you're choosing between two jurisdictions, for example, you would probably just go for a more tax efficient one. But primarily, you choose an offshore jurisdiction where most of your LPs would be comfortable investing, where you can get a bigger LP base. Number one. Number two, a jurisdiction where your contract enforcement is good. That jurisdiction has a history of venture capital and private equity funds, and those considerations trump the tax consideration.
So tax is then a mechanics question, a calculation question, but it's not really a driving factor in where you're domiciled.
Absolutely,
Okay.
It's not the primary consideration.
All right. So we've done two parts. We looked at term sheets, and we've looked at the legal and regulatory framework, and we've looked at taxes. Questions? Anybody? Any bachas? Sawalat before we move on to the next topic? Any questions from the group? Nope. So everything's clear, crystal clear. These बच्चेस are all born lawyer. मुबारिस हमें ये चीज़ें समझने में जो मैं ख्याल है 2.5-3 साल लगे, इनके फौरन 15 मिनट में सब कुछ समझ में आ गया.
Or maybe it's like the end of the day and everyone's like, yeah, last words of the khatam karo.
Yeah, I think it's the time of the day. It's like 6:30, 6:45 p.m. after a long day at work. They're all working, by the way. So, all right, acha. So I think the next question is things that have sort of gone wrong, things that that you worry about, things that have a tendency to explode, stuff that you watch out for. What would be on that list? And this is on both sides, both not just on the term sheet side, but just specifically within the venture investing side. Lessons that you picked up or learned, things that you would sort of say, keep an eye out for that.
Well, I think the cap table structure, I think, is the most common feature that I would say is comes up the most, right? And what's a suboptimal cap table? A suboptimal cap table could have a number of flaws in it. Say one investor or say one shareholder, uh, and I'm only talking about venture businesses. I'm not talking about businesses that are not venture profile, that are more PE in nature or that are more stable, your standard businesses. I'm talking about a venture business, which is a business that is capable of growing exponentially in the next 6-7 years, and it will be looking to access financing from VCs, and VCs would be investing in it. Now, what is a suboptimal cap table is a function of various things. It's about equity not having been distributed judiciously or fairly or in the right way. Um, an example of that is you are making a tech product and there are 4 co-founders, 3 are not techies, 1 is, and that 1 person has less than 5% equity. You're not incentivizing the main tech product bit enough. Another example would be you are one founder who is not full time on the business but owns 70-80% of the business. Again, suboptimal utilization of equity. Equity needs to be utilized to incentivize every shareholder to bring in something, right? Uh, Typically, founders, when they are not full time in the business but are founders and they are holding on to substantial chunks of equity, that's a no-go for any VC, because essentially a VC is backing the founder to begin with. And if the founder's bets are hedged, and if the founder is not doing this full time, then it does not make sense for anyone to be valuing a pitch deck for $5 million, right? So the founders have to be full time, and if they're not, then their equity is being wasted. That equity chunk being held by them is a waste. Similarly, uh, the other issues that I would see in a cap table is an investor who came on early and they just took a big chunk, and now nobody else is coming into the business. Those kind of investors would need to dilute themselves in order to attract more investment. Lastly, is not enough. Or the agreed shares are not being issued. And this is now actually a compliance issue, where बात हुई भी थी कि इतने shares देंगे, उसने बोला था हाँ सबने agree कर लिया था, लेकिन वो shares issue नहीं हुए, where now someone's leaving and now it's a whole padda. And again, you do not have or the most common padda that I see in founders, only where no investors entered but just founders are there around the cap table, is they do not agree कि what happens if one of us leaves, or what happens कि किसी को दुबई में नौकरी मिल गई और अब वो जा रहा है, वो पाकिस्तान में नहीं रहना. तो उनके शेयर से क्या होगा? Do they lose a substantial sum? Do they lose a smaller sum, etc., which is a very regular vesting provision in typical venture. So these are the issues that I think are very common, and all of them are fairly avoidable now that there is sufficient amount of capital available. And I think if you are going to be making venture investments as an investor, it's very important for you to understand whether the cap table is workable or not, and whether this cap table is going to be an issue in the future. Because if it is, then either you fix it before coming in or you don't enter at all. And that's what I would say is probably one of the more important issues to tackle.
So you mentioned a term vesting. I'm not sure if everybody's familiar with that. Could you just do a quick walkthrough of what does vesting mean? Especially, so a group of 4 founders have owned and run a business for the last couple of years, and they're now doing a proper venture round, and vesting comes up. So how does that conversation go?
So vesting is basically, sure, for example, the investor, again, our primary example, investors coming in, taking 10% for $1 million. So pre-money 9, post-money 10. The three other founders, and they all own 30% each. The investor would say that your 30%, while you'll own it today, or at least will be in your name today, uh, if you leave before a period of, say, 4 years, you will have to return some of it. So you only really fully earn this 30% or this number of shares if you give the business at least 4 years. And that's called vesting. So it typically starts with the investor says, if you leave within the next 1 year, you get zero. All of your shares are gone. But if you leave after that's called a cliff. After a cliff, if it's a 4-year vesting, each year you get your 25% of your shares are vested. So if you say if the founder had 100 shares, after year one, the 25 shares are vested. Now, even if they leave today, they will get those 25 and have to let go of the remaining 75. But if they leave after 4 years, they get the entire 100. Now, when I say leave in the middle, there's also it's also a question of how you leave. There's a good leaver and a bad leaver. A good leaver is someone who is leaving either because the company is asking them to leave for no fault of their own, because say company thinks that they need new management or they need more professional management, etc. That's one. Or the company is, or say they leave because say of illness, death, etc. And in those situations, that's allowed, and it's okay if you have to leave now. A bad leaver is someone who's leaving because they breached they've committed fraud, there's been sexual harassment, or there's some other crime that they've committed, or they've significantly breached their employment agreement with the company, which has led to a bad leaver provision. In a bad leaver scenario, even if your shares are vested, you lose a significant sum. You lose all your unvested shares, but even the vested shares, you have to sell back to the company at a lower valuation than what would be fair value. So vesting is a way in which the investors ensure that if they are actually investing in people, which are the founders, are they getting the founders to put in that time that they need in that business or not?
So how would you enforce that? And do you enforce it through employment contracts or do you enforce it through your shareholder agreement?
Both. The vesting is covered in both. The employment contract would cover the terms of employment, what would constitute a good leaver, a bad leaver. I mean, you could also put that in the shareholders agreement. There's different ways of doing it, but it would be covered in both.
Okay, got it. All right. I think Mubin has and Jawwad both have a couple of questions in chat. I think one question is from Mubin, and that is, what if a founder has 4 or 5 businesses that he or she is managing, like 4 or 5 private limited companies, all working under one holding company, and is also directed in all of them, and is a founder in this business? How does that work? As in, would you, as an investor, would you invest in them? Should you invest in them? Would you ask them to sort of leave and drop out of everything else? How does that work?
So, I mean, just to talk about Steve Jobs, who was very like gung ho and focused. If you're not focused on that one thing, startups are not easy. It's very hard. If you're trying to build 4 or 5 different startups, chances are that you won't end up building any of them. So personally, I'm a big fan of the focus school of thought, and I think most VCs would not be comfortable in investing in a founder that's running 4 or 5 different businesses.
Okay, so that's one. Mubin, was that your question, and was that the answer you're looking for?
Yes, sir.
Okay. I think the second question is from Jawad, and that question is, this is not me, this is Jawad Khan. This is, how would one of the investors dilute their share in case they own a substantial chunk of business? Would they sell? Jawad, why would they want to dilute? As in they want to
I think he's speaking about the situation where an investor has substantial amount of equity to begin with, and say 40-50%, and
Yeah,
now new
exactly.
investors coming in, and the new investor saying, we can't come in if this investor owns 50%. This has happened in Pakistan, and the investors who've seen sense of diluting themselves down are the ones who are now on the cap tables of very valuable businesses. The investors who've been still egoistic about it are not, and those companies are not raising any funds either. There are different mechanics. Either they could be they could transfer their shares to the founders, or in the next round you could issue more shares to the founders first, so that this investor at a very low value, at a very small amount for a small amount of money, and this investor gets diluted inordinately, and then the new investors come in. So there are different ways of doing this. But yeah, it involves either transfer or issuance of new shares.
And I think there's a
All
third
right, sir.
question.
Thank you.
Third question from Mubin is, when you are taking the shares back from somebody who's leaving, how do the calculations work? Are you looking at book? Are you looking at last round? Are you looking at somewhere in between? How does the math work?
So it's a function of the last round's valuation and a fair value construct, where you get either an auditor plus an independent person with a background of a VC to value that business. So if it's a ride hailing business, their typical metric is, the North Star metric is rides per day, which is what they're tracking on a regular basis. Then they'll say, I was doing 50,000 rides per day and my valuation was say 20 million or 30 million, and now I'm doing 100,000 rides per day, then it's fair to assume that my valuation is twice as that. But again, there are other considerations around whether that business has entered new markets, whether that business is sufficiently more de-risked. If those considerations are true, then that would also impact that valuation, right? The valuation of the business would be based on on the same metrics or the same mechanism that you typically have been using to raise more investment. But of course, remember that when you're looking to raise investment and taking capital into the business, that valuation versus someone buying a secondary share, say buying it from a shareholder where the cash is going into the pockets of that shareholder, that valuation is usually discounted. So a secondary sale is typically always done at a slightly discounted valuation to whatever valuation you're raising actual capital on. Again, it'll be a lot of those factors combined in that situation.
But these are not happy conversations, as in these are difficult and troublesome conversations, right? Awkward conversations.
Depends. There's sometimes early employees, founding team members, an early founder, they want to leave and start something else, and they want to sell their shareholding. If the business is on a good trajectory, then why not? People are happy to buy those shares, and sometimes this conversation can be happy as well. But if it's a bad leaver scenario, then in that situation, yeah, it can't be. It's not typically a happy conversation.
So my question is, in a good lever conversation, early founder, is now done for either for health reasons or family reasons or personal reasons, wants to quit and wants to leave. Business on a good trajectory. They've just done a good round. The round's been closed, and he says, "Okay, I want to leave, and I've got this chunk of vested shares." Who is going to be the most likely buyer? An existing investor on the cap table, business? Is there going to be like a proportionate allocation of the shares and everybody buys them out? How does that process and conversation work?
So typically, if the new round has been on the back of this founder, it'll be difficult for that founder to exit, right? If say Muni, when he raised from Naspers and all, if they're backing Muni by Kia, then they don't want him to leave immediately. However, what typically happens in these kind of deals is that, or for this, that everyone recognizes that the founder might have some need for a little bit of liquidity at some point. And there is typically a pro rata right of first refusal that all shareholders have, especially the investors, whenever an existing investor is selling shares. Now, that store offer typically drives down the price as well, because you can't go to a third party and get a fair price or a good price for your shares, and that's typically difficult. So what investors typically, or the founders typically, do is keep an allocation of, say, 5% of the shares held by the founder, or 10% of the shares held by the founder, which would not be subject to any restriction, and which the founder can sell freely. But still, whatever value they get from outside, they would still try to offer it to it would be offered to the investors, existing investors, and invariably they're the ones who want to take it first. Because if I'm just investing in a business and I have a thesis around this business doing well or growing, I would want, in most cases, would want another chunk or a bigger chunk of that business.
And are there scenarios where because the vested founder has a, a thick chunk of shares and he is leaving, are there any scenarios where the business simply say, "हाँ जी, आप ले जाएं, take it with you, and we'll just dilute you down to something smaller in the next couple of rounds"? Is that acceptable, or is that not possible?
No, that's not possible. Dilution is proportionate. So you can't just dilute one shareholder down disproportionately unless they agree. And if the shares are vested, then the founder is free to go do whatever and own those shares. I mean, it's if the founder owns those shares, it's because they see the economic value, and the economic value of those shares could quickly erode. If the business is heavily dependent on that founder, and if the founder leaves, that value might just erode immediately. So founders are also very careful about making sure that or at least good founders would be very careful around making sure that the shares remain valuable, and the value of the shares remains protected.
No. So what I meant was, I didn't mean they would dilute one down. I'd simply say that if I were to do 3 more rounds in the future, by the time the third round's done and we sort of raising more capital for scale and growth, your 15-20% stake would come down to maybe about 5%, because you're no longer investing with the funds, and because you're no longer part of the team, you're no longer getting additional grants or incentives or alignments from the new investors. And in that context, my question is, if somebody has 10, 15, 20% of a business, was one of the original core founder, decides to step out, how common is it for that person to walk away with that equity while no longer contributing to the growing business? Is that acceptable to investors, or would you sort of have a big issue around that?
Depends which stage the business is in, right? I think Bill Gates is still the largest shareholder in Microsoft, and by largest I mean 7%.
Individual, yeah.
Individual, yeah, one individual, not like an entity. 7%, which is what it's diluted down to, but that 7% is worth quite a bit of money, right? So your number of shares will always remain the same in percentage terms, because new shares are being issued, it would dilute down. And and founders aren't necessarily, once the business starts getting bigger and bigger, founders aren't necessarily issued new shares. They're expected to just hold on to those shares, and obviously their salaries and other incentives, cash incentives, get better with time, and they're still free to go and do what they want if the shares are vested, and yeah, it's even if in percentage terms it's less, it's hopefully it's more valuable than it was with a higher percentage.
Okay, all right. I think there's something that we've been talking about in the class, and this is sort of like off topic on the different side. I think it's something that sort of we've raised and challenged and pushed a couple of times, and that is, the case for Pakistan now. So you've been part of the ecosystem for a while, and you've seen a lot of conversations. You've been party to a lot of conversations. How has the case for Pakistan changed in the last 2 or 3 years? So if you're saying, if you're looking at Pakistan as a destination for venture funds, how has that conversation changed in the last 2 or 3 years? What's new? What's different? What is making investors and funds excited about looking at Pakistan as a possible market?
So a lot of things are going for Pakistan, right? They always were. It's just that we were behind Vietnam's and Indonesia's, etc., because a few reasons. primarily the fact that we got the 3G spectrum thing. We royally delayed that, and we got that really wrong. If the timing around that was right, Pakistan would have been much further ahead than it is right now. Um, it's a huge market. It has with this now phones have penetrated. Digital was now. Why is digital infrastructure so important for VC? Again, fundamental is that someone gives money to a VC to make outsized returns in the next 7 to 10 years. Now, what kind of business can make outsized returns in the next 7 to 10 years? A business that grows really fast. In the US, and if you read Mark and Andreessen's Software Will Eat the World, the beauty of software or digital product or digital service is the fact that there's a very low marginal cost of application. Um, if if I'm making content or if I'm making software for one person to give 10 more people the license for the same is not going to cost me much more. The main cost was just making that one thing. So essentially, those businesses or tech businesses are scalable, and VCs are looking to invest in scalable businesses. So having the digital infrastructure in place is essential or is crucial before a VC would really be, or global VCs would really be interested. What has changed over the past 2 years in Pakistan is COVID. COVID has accelerated adoption of digital to a point where I mean, at least I thought that was probably another 2 3 years away. But we have really. I remember at one point I was part of a startup called Bukla and Parksine, and we were selling electronic signatures and contract management software to banks. And we had to really, I mean, I'm no longer part of it. I've sold my shares to my co-founders, but we had to really work hard to convince banks, okay, listen, this is an easier way of doing it. This is, you can give your customers convenience. It'll be easier for you. And I remember 2 months in COVID, those guys were calling us and they were like, listen, आप एक बार आए थे वो बेचने electronic signatures का क्या है? And I said, listen, आप मेरे please co-founder से बात कर लें. And वहाँ पे वो है. But just to give an example, that there is a substantial amount of interest suddenly because everyone realized that they need to adopt a digital channel. I was reading State Bank of Pakistan recently published numbers around e-commerce and growing electronic transactions. The numbers, it's 40% of like year-on-year growth. I think it's going to be more now. That's one massive shift. I would also say two regulators and right people at the helm has really helped. Raza Bakir Saab at State Bank of Pakistan and Amir Khan as chairman of SECP. Those guys have been brilliant. They have rapidly brought in the changes that were needed, the regulatory changes that were needed to give foreign investors comfort and to make these kind of transactions possible. All these things combined, and the fact that the world realized, listen, Pakistan is fifth largest population of the world, and in terms of VC financing, is this it's a fraction of what it is in other comparable markets or even in other markets. So all these things combined, it's just all tied in together this time.
So I think the numbers that you spoke about, I just ran them this afternoon for something else that I was doing. If you look at year-on-year growth from Jan to March 2020, which is the quarter before COVID, and you look at Jan to March 2021, which is the quarter just before the third wave hit, e-commerce value year-on-year growth is about 115%. E-commerce volume, which is transaction, right, is about 100%. Internet banking value, which is the rupees moved on that channel, 108%. And this is the big one, mobile banking value traded on that platform, about 177% over a period of 12 months. That's the growth metric in these numbers. And you now have sorry, Bolo, go ahead.
And just to develop on that, any VC's thesis or for a market is that consumption of that market would move towards digital channels, and those digital channels are the ones that you need to own a part of to create and capture value. And that's exactly what Pakistan's seeing now. So it's actually perfect time to be investing in Pakistan or starting a business in Pakistan.
The other two numbers which are of interest, one is your internet banking users across Pakistan, same time frame, and the other is your mobile banking users uh, across the same time frame. This group, and there the numbers are really interesting. So you now officially have about 10 million mobile phone banking users, which basically means there are 10 million users who are using their smartphones to access, trade, work, transfer, and engage with their accounts. So that's a good metric, right? 10 million digital phone banking users basically makes you a larger market than Saudi Arabia, than UAE, um, many of the smaller countries in Europe, and maybe some parts of the Far East. So that metric, and this number in 2019 was about 6 million, and the rate at which it's growing, you will touch about most likely about 12 million users this time next year. So 12 million mobile phone banking users is a really solid indication of where this country is heading. It sort of adds up to one of the questions we'd asked in our class was uh, um, what is the size, what is the number or the reference of or a good proxy for indicating the size of the middle class in Pakistan. And I think these 5 or 6 numbers sort of give you a really good solid indication of where things are going. So you're bullish. Is that a fair assessment?
Yeah, I mean, Jawad, for us to stick around in this space, we have to be a little optimistic on
Little.
on the naive end of optimism. But I guess the naive optimism also paid off because we're right in time when COVID hit and the world changed, and the world changed obviously for the worse for a lot of people. But as far as these metrics are concerned, and as far as digital adoption is concerned, it moved the needle in Pakistan. It moved us much faster and accelerated digital transformation and adoption in Pakistan. So I would say for sure, I'm definitely optimistic. One thing that I'm a bit wary of is our the founders and I see a lot of founders, and some of them are quite, they understand their space quite well, they understand Pakistan quite well, but some are again now a little too naive in their optimism. I don't think every company will be a unicorn, and I don't think that's a bad thing. Um, it To keep chasing unicorns is also not optimal. There will be a lot of very valuable businesses in Pakistan, which would be like in a very good valuable range. And one thing that I wish most founders understood was that by taking money early on at a high valuation, now we keep giving the 10 million example, the expectation is to deliver a high return. Now, if the investor is entering at a 10 million post money valuation, for that investor to make a 10x, he has to exit at 100 million valuation without there being any dilution. Now, what founders are doing by taking on or bringing on a high value early on is by locking out a very sweet exit spot at 30, 40, 50 mil, which is possible in Pakistan. And I wish more founders understood that venture is probably not the only kind of money to raise, and it's not the only form of financing. There's you could always, I mean, equity is obviously the most expensive form of financing, but if you're capital efficient and if you raise less, and if you raise from say strategics, angels, and maybe some small cap PE, you might still be better off. So there are pros and cons of venture, and it's important to not only tie yourself to a venture type of business. It's what's great about Pakistan now is that it's the best time to be an entrepreneur in Pakistan, and venture is and capital is just a means to an end. So it's just that there's now availability of that capital, and I hope there will be different forms of capital available. to the Pakistani entrepreneurs in the near future.
All right. So next question. Next question is, we haven't spoken about exits. So we've spoken about term sheets. We've spoken about conflicts and different perspective and point of view between founders and investors. We've spoken about the structure. We've talked about tax. But what needs to change on the capital market side for exits to become easier and more common? So, one exit is you get acquired, right? Well, that is a question mark. But a easier, much more reachable exit is going for a listing on the local exchanges. So, how are things on that front?
It's still possible, right? But it again depends on what business model you're running and how what the appetite of the retail investor on your capital markets is. If the retail investor on your capital markets is conservative and is not going to be funding or willing to invest in a business, say where the North Star is not the revenue, North Star is growth related metric, or it's a usability related metric. If that's the case, then you won't be able to find much money in the capital markets, so nobody will be able to or would be interested in buying it. Now, that's number two. It's a function of what has been the largest IPO in Pakistan. What's the most amount of money that has been raised in an IPO in Pakistan? I'm not sure about this year, but before the last few IPOs, I remember it was Incotex or the textile one. I
In
forget the name.
Sialkot, the
Uh-huh.
Adidas one, right? Yeah.
Yeah, exactly. Those guys that they raised around closer to $30 million from their IPO, and I think the valuation was around. I'm not entirely sure what the valuation was, but it was maybe the dilution for that was around 20 odd percent. So roughly 100, 150. Now again, I feel like more capital is available from just VC investors and just privately available. Uh, Now, why do most companies acquire other companies? It's either uh, especially from a Pakistan context, it will primarily be someone wanting to enter Pakistan as a market and wanting to cut down on the time it takes for them to set the operations up, get licenses, and get team, etc., etc. They would say, let's just buy this out. It saves us on this much time, and we already buy into too much traction. Those kind of exits, I feel, are will happen more and are most likely to. I mean, we've seen them with the Raz, we've seen them with Easy Pesa, but I would say even the small cap exits would be more commonplace in Pakistan. It's just that only now we have had enough time for even the initially venture funded businesses now to be in a position to be acquired.
All right, we have one question from Mubin, and that question is, 10x or 20x return over the course of 10 to 15 years is like 25 to 30% per annum growth. Why take the risk here when you could get similar returns, which much more safer real estate investing?
No, that's a good question. It's about portfolio allocation and how you diversify risk. Listen, if you're a Pakistani LP and you're committing, say, a million or two to a venture capital fund, chances are you have substantially more in property already. And you probably made those 1 or 2 million from property. So the point is to diversify your own portfolio, you would keep a small allocation for venture. Uh, One. Number two, you can make outsized returns. Like by outsized returns, I mean what's the most successful VC fund in history? I think it was Chris Saka's lowercase capital fund one, uh, which was a $10 million fund, but he only drew on $8 million out of that. And I believe the return was 163x. It's insane because he ended up investing in Uber early on, Airbnb early on, and one or two more, which got really big. Idea being 2 or 3 companies in his portfolio ended up crossing like a $10 billion mark. Uh, that's the kind of insane returns that can also happen, right? So um, that's another consideration. And one more reason why investors invest in businesses, it's people LPs invest in these funds, is as a means for deal sourcing. So they get a good sense and pulse of what's happening. I mean, you would have to hire a team to sit there and to go through all these deals happening in Pakistan and then try to get into one of them, or you could invest in a fund and all you're paying is a management fee and with a potential upside as well, and you get to scout these deals to make direct investments as well. And in those direct investments, you could be making far more and far quicker. So it's 10-20x wale ke alawa bhi you could be having direct investments in which you could be making maybe 3x in 2 years, or like something even more ridiculous than that.
Okay, did Mubin, did I answer your question?
Yes, sir.
So are you going to dilute your real estate portfolio and invest in venture?
That sounds like a very good thing to do.
Okay, all right.
Part of it, not all of it, not all of it. Venture is the riskiest form of asset. It's the riskiest asset class.
Okay, all right. Any more questions from Mubariz before I move on to the next topic from the group? So Mubariz, I think you've sort of been involved in what would very soon be started to call the historical phase of a market, right? At different levels, both as a founder, as an executive in residence, as an advisor, as a lawyer, as even as part of both on the side of the investee companies as well as the investors. For somebody who's looking at venture capital in Pakistan at an initial stage, what would be your 3 top tips or advice to them? 3 things that you should remember, be aware of, be wary of, be careful of, watch out for.
I think watch out for the most importantly, watch out for number one. This venture capital is all about access. If you're a fund manager, um, and you want the best founders to take money from you, right? The best founders, people who are capable of building those big businesses, they will invariably attract different investors. A lot of different people would want to give them money, and a lot of people would be after them to take their money. Why would they choose you? And is the question that you ask. So since equity is the most expensive form of capital because there's permanent dilution, um, what you need to be building on is why your capital is smarter than somebody else's capital. I think the best example is probably YC, who have been able to build that machine, which just people are willing to take that standard deal from, and which is a very pretty low ball deal, that 7% for 120K, 130K, something like that. So yeah, that's a good powerful machine to build. So the first thing I would say is access. Second thing is the value you will provide. Obviously, you need to be able to build actual genuine value. And why would so once people have chosen you, you need to actually be able to deliver that. So it would be heavily dependent on whatever your firm thesis is, and be very careful about and be very true to yourself around. It's very easy to be undisciplined. It's very easy to go all over the place, but it's very important for you um, to make sure the value that you always or the values that you were there or initially started off with, you're there to throughout. Um, and lastly, I think it's just understanding how to say and when to say, and mostly say no, because most in most situations as a VC you will be saying no. And that's very important, because if you were to say yes, you'd be out of your entire fund in the first 20 conversations, right? Because every day there are people pitching to raise money, and a lot of them are not either not venture profile businesses, or just not operating in markets that are big enough to give those returns. So to be optimistic about the market to the point where you think the market doesn't exist now, it hasn't existed in other parts of the world, but somehow will exist in 3 years down the line in Pakistan, is being, I think, overtly optimistic about a scenario. So understand the realities of Pakistan, understand what can and what can't work in Pakistan. I would say is the third one. So access the value add that you will have, and then the third, understanding the realities and navigating the realities of Pakistan is very important.
All right, perfect. Thank you so much for that. So now my last question, and then we'll wrap up. Uh, Last question is, any words of advice or suggestions or guidance to the group that you have in front of you? These are essentially graduating students of BBA at IBA. They have, I think, a background in investment and finance and accounting, right? So mixed group, some from a marketing side. What would be your advice to them?
I mean, I would say, while this is a new space has opened up in Pakistan, so pretty exciting time to be just graduating right now. Uh, I would say there are so many funds now, or at least more and more funds starting. Why don't it's probably a great time to actually work on the equity side, which has not been an opportunity that has been available to previous graduates in Pakistan. Typically, finance jobs are around either capital markets or around which is the equity research bit that you can do. Otherwise, it's all debt, and in banking. And in banking, it's investment banking, which lends to the government of Pakistan, or 10 blue chip companies in Pakistan. So you actually have are at a very good phase in Pakistan where you can actually work for a venture capital fund, where you're doing research in private equities, and where you're doing research in markets. And for me, the best part of working at a venture capital fund was actually meeting founders who every single day who were just looking at Pakistan a little differently, who were looking at the problems in Pakistan a little differently. And I think I benefited from that immensely, because it was like a 30-40 minute crash course into a whole different problem, and which was linked to an industry. So I would say it's a pretty exciting time to be in Pakistan. There are many ways you can be a part of this space. Becoming part of the investor or the VC is not only one of them. You could also be part of a startup. In that you will be understanding things from a very micro in that industry point of view, which is also very exciting. So my biggest tip would be to take those risks, to find. I think early on in my career, when I was choosing which kind of law I want to practice, from criminal to corporate, to even in corporate, there are so many work from project finance to startups. What I decided I wanted to do, and it's just that the industry you choose are the people you'll be hanging out with or meeting mostly. And I'm so glad that I am part of this, because this gives me an opportunity to meet with other optimistic people, because I'm naturally optimistic by nature, and also builders, people who aren't really taking no for an answer, and who genuinely believe they can solve problems. So I would say stick to, or and align yourself with, and try to hang out with the builders, people who will be solving problems, and building and creating value.
So Mubin is really upset at you. He's saying, you don't, as a venture capital investor, you won't invest in a founder working in multiple businesses, but that's exactly what you're doing as a VC. You're investing in multiple businesses. So how is that a fair deal?
So the entire point of a VC is to identify founders who are dead focused on working on a problem. And the entire thesis is that you will find a set of 12, 15, 30, 20 founders, and just deploy capital. You are working on one business. Like, if I was a VC fund, I would be first deploying a fund, and once that fund is deployed, I would then move on to another one. Thing is, it's not the same thing. The level of attention required, the level of detail required, the level of uh, the hard work required is not the same. Uh, Founding a business is much harder than being a VC, and I sometimes can't believe VC is a thing, because look at what's happening. If you have a 20 million fund, $20 million has been allocated to you. You get 2% a year flat. No matter what you do, whether you perform well or not, you're getting 2% a year. So 20 for 10 years. So 20% of the fund is just your management fee. And if things don't go well, so $2 million is in 10 years is what you've made for sure. So $200,000 a year, which is a pretty good management. Uh, if if things go well, you can take 20% of the upside. If things don't go well, then khuda se koi masla nahi hai. So I just feel like VC is just not a fair deal to begin with. So if you're upset around VCs, I get it. But being a founder is much harder, and it needs a significant amount of focus.
Mubin, did that answer your question?
Yes, sir. Yes, it did.
It did? Alright. Perfect. Alright, G. Questions? Last questions before we let Mubariz go because it's Maghrib. Sawalat. Any questions? Any queries?
I think everyone's really tired. Long day at work.
No, they're really smart kids. They've understood everything you explained. As I said earlier, जो हमें 25-30 साल लगे समझने में, उनको 15 मिनट में सब समझ में आ गया. But Mubariz, thank you so much for taking out the time to come speak to this class. These poor kids have been burdened by me for the last 6 weeks. Last 6 sessions. I thought it was time to give them a change and a different flavor and different outlook. We're going to come back to you maybe a few more times with questions and queries as they arise. And if there is a need, we may actually ask you to judge and gauge some of the papers that they produce towards the end of the course. But other than that, thank you so much. बहुत शुक्रिया आपका. I hope everybody's enjoyed this session and has gotten a good sense of the industry, the current outlook, some of the challenges, some of the issues, the terminology, and the context.
Thank you very much for having me, Jawad. I think I enjoy these interactions and these questions because you don't really get them otherwise. So thanks a lot for having me, and always happy to support you guys any way I can. So feel free to reach out. I'm fairly active on social media, so we're happy to interact and happy to address any questions in the future.
What's your Twitter handle, Mubariz? Can you just dump it on the
at Mubariz Siddiqui? My name se pehle bas at. That's it.
Mubariz Siddiqui. Perfect. All right. I think some of these guys will follow you and figure out what's happening. Perfect. So Mubariz, I'm going to let you go. I'm going to hold them back because I want to sort of do a quick review with them before the class ends. So thank you once again, and we'll be talking to each other, inshallah. You still owe me that little piece of paper?
Yeah, I do, and this has also helped me draft that paper. I do realize, Jawad, that I am the host. Oh, you're the host, so it's fine.
I was sneaky. Yeah. I was very sneaky.
Yeah. Very good, excellent. Sure. So I'll share that paper with you as well, and I want to publish that as a little bit of a blog too. But we'll definitely go around it. We'll share it with you and publish it.
Great. Thank you so much, Mubariz. Thank you so much. Allah Hafiz.
Thanks.
Have a good day.
Take care.
Have a good week.